Hey guys, Max Convexity here. Hope everyone's having a great day. The Austin Strangler is back. Oh my gosh. The Austin Strangler is back. I'm going to talk about the straddle strangle swaps a little bit in this video. All right. It's also called Earnings Season is Here. It's really about a strategy that I've developed that deals with straddle strangle swaps in any event. But seriously, there's a serial killer on the loose in Austin. They found 10 bodies in Lake Austin over the past couple of years, and it's kind of a crazy deal. All right, so we're going to talk a little bit about Max's two-step today, and I have a longer video about it, but Max's two-step went dormant for a couple of weeks because earnings strategy ended. But it's basically a earnings strategy that has two steps, a long vol component and a short volatility component. And I'm just paper trading it on earning stocks during earnings season. Step one is to put a long volatility strategy on a stock that has earnings in the following week. So we're going to do that in a second. We're going to look at a Boeing. I think Boeing has earnings next Thursday. Boeing's been volatile lately. So we want long volatility on that one. All right. Then step two is during earnings, like next week, we're going to put on short volatility strategies on things that have earnings that week. But for now, we need to look for a long volatility one to replace Netflix with. We had Netflix was our long volatility one this week, and American Express, but they're both getting ready to expire. We'll take a look at the spreadsheet here in a second. I intend to test this through an entire earnings season. And then I intend to do it with real money too. I've tested this a lot before, but I never follow it through and get enough data. I always never have enough data. You know. All right. So yeah, Netflix was the long trade. They had earnings. I made these slides yesterday and I didn't have a chance to do this yesterday. These things have risk just like any strategy, even though this is a delta neutral strategy and you have a long options, you have a long option positions and short option positions. You could still lose on. They don't always hedge each other, and you can lose on both sides of them. All kinds of crazy stuffs happen. Let's do this. Let's go to the spreadsheet right here. I have a really primitive spreadsheet, but my spreadsheet is an example of why you shouldn't, don't. What's they always say? This is not professional advice, and this is a good example why. My system that I was paper trading, if someone would have followed me, they'd be going great. I made $1,400 the first week. Well, the second week I only made, or I lost $109. Okay, so step one is the first component. That's the long volatility component. Step two is the short volatility component. The whole theory is you're long and short at the same time. I'll make a more detailed video about this later, but you shouldn't be able to be hurt by too many big moves down. And this is the way you are long. Step one is you put on a trade that's the same trade Tress does. It's a straddle strangle swap or a ratio double diagonal, as you could call it. It doesn't matter what you call it. We'll get in the middle of it here in a second. Netflix, I've already taken that one off. You have to take it off before they actually announce earnings. This step one is just pre-earnings. For instance, Boeing will go on, and then we'll take it off before, they announce Thursday after the bell. We'll take it off Thursday before. So I want to show you how to construct one of these things from start to finish. And then I'll probably let you guys just get out of here. I don't want this video to be too long, but I just want to kind of update the spreadsheet and check in and see how we're doing. Let's do the Boeing trade, and then I'm going to show you how these other trades are doing. And yeah, that also shows you I'm not having a good week. Don't do these trades yourself. We're going to follow it. We're going to figure out better rules to refine the rules. So the strategy is going to evolve, so in any event. All right, let's look here. Well, I guess first, let's look at our safe trades. Okay, this Tress trade, that doesn't have anything to do with this. And neither does the one that says 30 trend runner. That's something else. But all these other trades are step one or step two, and they have it over there. So here's a step two trade that may be $91. That's a short volatility trade, and that expires here in 5 minutes. I have a step one trade for next week. This is a Tesla position for because they have earnings on Tuesday. So here's the Tesla straddle strangle swap or ratioed double diagonal. The beauty of this, in case you haven't seen my first video, what you're going for with step one is you're going for the market. It protects you against a big move. If the market drops 10%, if Tesla drops 10% or 18%, these options are worth a ton of money. If it drops 20%, this position's worth $2,000. And it has unlimited gain. And it can also, if it goes up, same thing. What you're actually playing for is a boost in volatility. If the volatility gets boosted next week, and we expect it to stay high and maybe even go higher into earnings, you can get in a situation. That's what Netflix did to me this week. With volatility expanded into earnings, and this has, even if the price doesn't change, volatility expands into earnings, this Tesla position will be worth $262. That's what's happened to me on Netflix. Netflix didn't move before earnings. It moved 6% down after earnings, but it didn't move before earnings that much. Volatility expanded into earnings. I took it off 5 minutes before the end of the day. It was up $172. This one is, maybe hopefully we'll get a chance to do the same thing on Tuesday. Here's the other thing though. If we have a market crash over the weekend, if World War III does start, we don't want that to happen, but we'll be covered. At the same time, if it comes out over the weekend that Elon says he's running for president and he's going to solve all the world's problems or something, and everything's great, boom, everyone gets a free Tesla. Let's say everyone gets a free Tesla and a free puppy. It comes out over the weekend. Well, and Tesla's up, 20%. This strategy will profit also. Okay, so now let me show you how to build one of these really quick. I'm trying to make these videos quicker. I'm sorry I'm talking faster, but I'm trying not to talk about nothing so much. Here's how you build one in Option Strat. You go to double diagonal. In real life, I would have already done this because there's not enough time left in the day, but Option Strat, it's theoretical. But I would have done this sometime. And actually, Boeing has earnings next Thursday. I would have done it yesterday. You want to have the long volatility one on for about a week. So you go Boeing. Okay, it's called a straddle strangle swap because the bottom options are underneath. That means they're sold. That's a 170 put that's short and a 170 call that's short. That's a short straddle. Okay, that gives you a profit and loss graph where if the market goes nowhere, you make tons of money. Anyway, you're selling a straddle in the near week. We want to do it. Wait. Oh, no, that's right. That's right. Never mind. I'm sorry. Don't look at that. All right. We're selling a straddle in the near week, which is for next Friday, April 26th, to finance a strangle. Now, a strangle is options that are not the same strike. They're out of the money options. So anyway, that's basically to me what a straddle strangle swap is. There's different versions. What the Trish trade is, the Jay Pestricelli, the badass, ratioed double diagonal, is you just add a contract on of the longs and you keep the shorts at 2, right? Boom. Then all of a sudden you have that. Okay, so I'm just going to hit save trade. The program on this automatically saves it where I get terrible fills. I have to buy it at the worst price of the bid and the ask and sell at the least advantageous price. So I don't get any splitting the middle. So I think it's pretty realistic. I think it's actually kind of hard on me. There's trades in here that I lose on that in real life I think I would win on, but I'm trying to be conservative. But so we're just going to go. I just write step 1. And it's a Boeing's. Let's see. Okay, but it's more important than just this. I don't care about Boeing's earnings. I do care about the market overall. So if you look right here, I have on American Express, they have earnings next week. Tesla has earnings next week, and Boeing has earnings next week. So I have 3 long volatility trades, right? All right, and all these short volatility trades are getting ready to expire or already have. Then as we get into next week, I'll pick some short volatility trades. Like on Monday, I'll find a stock that has earnings after the bell, and we'll put on some kind of short volatility trade. And we'll find 3 of those throughout the week to hedge the 3 long volatility trades. Try to be delta neutral the whole time. All right, look at this. Look at this real quick. Okay, so yeah, so here's our short. So we put step 2 over here. Step 2 did terrible the first week. Step 2 is, to me, is a lot harder. But in any event, I'll go fill all this out and then we'll have a report over the weekend. But it looks like this is going to be it looks like this is going to be a loser. Okay, because my step 2 Procter and Gamble, that looks like a $92 winner. That's going to expire. Las Vegas Sands was a $1,000 loser. It was a short volatility trade, and Las Vegas Sands dropped like after the earnings like 20%. Anyway, the Tress trade doesn't count against him, but in the BAC trade. So basically, I had a $1,000 loser and like a couple of $100 winners. So anyway, that's the way we're just paper testing it, right? All right, guys. So we'll see. We're pulling for some Boeing volatility or some American Express volatility for next week. Right? I want to, but now that I said that, gosh darn it. Did American Express have earnings this week? Earnings announcement. I'm pretty sure it's next week. Yeah, 9 hours ago. No, they already announced. Okay. Well, okay, go figure. My bad. Anyway, whatever. So here's the problem with that, though. For the purpose of Max's 2-step, I was supposed to take that off. I was just busy doing that stuff for the charity yesterday. I'll have to go back and find yesterday's price, but all step 1 trades have to come off before earnings. And that's an example of why. Maybe this wasn't such a bad thing to happen. That's an example of why, because right now it's underwater $197. If I would have taken it off right before earnings, theoretically, I could have taken it off for money. Now it's past 3, so it's already expired it for me. All right. Well, in any event, that was supposed to come off. I'm gonna, for the purpose of the bookkeeping, I'm gonna include that as the $196 loser. You know, just because it's just a trading error. But that was, I should have brought that off. And I guarantee you, when it lost 190, it's at least usually even. Those trades, they're usually, you can make a little bit of money or break even if you take the long volatility trade off before they announce. After they announce, volatility gets crushed and then they lose money. Anyway, my bad on that. So after I add all this up, it's going to be another losing week, and we'll see where we stand. I'll have a report this weekend on that. All right, guys. Thanks for tuning in. Let's go back to the slides and make sure there's nothing else here. Yeah, you can lose on both sides. Volatility collapse can kill you on step 1, but you can lose on your short volatility at the same time, even though they're theoretically hedges against each other. I'm just trying to point out it's hard. It's kind of hard to, but you can lose on both sides. So it's not like you can just do this with all your money. Obviously, can't do anything with all your money. It's safe, but it's not, you know, somewhat safe. Let's just say that. These are also expensive. They tie up a lot of capital. That's the other thing about the ratio diagonal or the straddle strangle swap. I'm basing this on a $20,000 account. But and that's what you would need to have 2 or 3 of these on at a time. These can cost $2,000 or $4,000 to have just one lot of one of these on. The Netflix one costs, I forget, $3,000 or $4,000 just to put on or something. All right. Yeah, but the thing is, I always do put them on and take them off as one trade. I don't manage them separately. That helps you with, I think you get better feels that way, but some people take them off separately, but teach his own. You guys have a good one. I will talk to you later.